Contrary to popular belief, financial discipline is not about the width of your wallet, but the depth of your character. True wealth rises not from technical data, but from unshakable behavioral consistency. Markets are complex, macroeconomic cycles are uncertain, and geopolitical risks emerge suddenly. Yet an individual's own behaviors are predictable and, more importantly, manageable. This is precisely why it is impossible to build lasting wealth without understanding the behavioral foundations of financial discipline. Ultimately, we must decode the psychological patterns behind financial discipline. Let us examine this in detail together. Behavioral economics teaches us that human beings are not rational, but predictably irrational. Loss aversion, herd psychology, the tendency toward instant gratification, overconfidence bias. These are not abstract academic concepts. They are real dynamics that manifest every day in investment decisions, spending choices, and savings rates. When an investor panics and sells during a market downturn, the issue is not a lack of information, but a lack of emotional regulation. When an employee increases spending at the same pace as a salary raise, it is not due to insufficient income, but to poorly designed behavioral habits. This is where the true power of financial discipline comes into play. Real discipline is not a momentary display of willpower, but the result of patiently and meticulously constructed habits. Someone who exercises every morning does so not because of motivation, but because of habit. The same principle applies to saving and investing. An individual who sets up automatic investment instructions does not attempt to time the market. They trust their system. Someone who consciously categorizes their expenses does not ask at the end of the month, "Where did the money go?" They already know. These small but repeated behaviors create a compounding effect over time and ultimately build wealth. Compound return is not merely a financial concept. Behaviors compound as well. The seemingly ordinary small decisions of today may be the hidden seeds of tomorrow's massive transformations. Allocating 10% of monthly income to an investment fund may appear insignificant in the first year. But when sustained for 10 or 20 years, not only does capital grow, your identity transforms. You are no longer someone trying to save money, but an investor. The most powerful key to financial transformation is not what you achieve, but who you become. Because, although the human mind pursues goals, our actions are always shaped as reflections of the identity we embrace. Time preference is the foundation of financial architecture. What behavioral finance defines as intertemporal choice is, in essence, the delicate balance between the impulse for immediate gratification and the vision of long-term prosperity. Most people choose a small reward today over a larger reward in the future. Credit card debt, unnecessary consumption spending, and unplanned borrowing are the consequences of this short-term mindset. Wealth building is the financial equivalent of patience. The fundamental equation here is simple. When you place your future financial autonomy above the pleasure of present consumption, you open the door to lasting prosperity. This is a matter of mental framing before it is a matter of mathematics. Financial discipline is less about relying on willpower and more about constructing an intelligent environmental architecture. While willpower is a depletable resource, well-designed systems are resilient. Structural barriers, such as keeping investment accounts out of sight or automating savings, serve as the strongest line of defense against our cognitive weaknesses. A similar logic exists in professional portfolio management. Risk diversification, asset allocation, and rebalancing mechanisms limit emotionally driven decisions. Personal finance should operate under the same principle. The role of habits in wealth building becomes especially evident during periods of rising income. As income increases, a rise in living standards is a natural tendency. This is known as lifestyle inflation. Without financial discipline, higher income does not translate into greater wealth. Those who remain financially stagnant despite high earnings are the clearest proof of this behavioral fallacy. In contrast, a financially mature individual uses increased income not to elevate lifestyle standards, but as fuel to strengthen their investment capacity. Increasing the savings rate as income rises is one of the most powerful strategies for wealth accumulation. Another critical behavioral factor is risk perception. In financial markets, risk cannot be completely eliminated. It can only be managed. Yet individuals often confuse avoiding risk with avoiding opportunity. Remaining in cash during an inflationary environment is also a risk. Choosing not to invest at all is, in itself, an investment decision. Financial discipline requires analyzing risks with composure and remaining loyal to a long-term strategy. The focus should be on intrinsic value rather than daily price fluctuations. Over time, this perspective builds the capacity to act independently of emotional volatility. Debt management is also directly linked to behavioral foundations. Debt is not inherently negative. When leverage is used for productive assets and managed correctly, it can generate growth. However, uncontrolled debt for consumption purposes is equivalent to spending future income today. Financial discipline teaches the strategic use of debt. It requires analyzing the difference between the cost of interest and the expected return. When this analytical way of thinking becomes habitual, individuals begin making financial decisions based not on emotion, but on structural reasoning. Market cycles are the litmus test of financial willpower. The euphoria of rising markets can turn everyone into an investor. However, true discipline reveals itself when the market begins to bleed. Choosing to remain composed and search for opportunity instead of pressing the panic button as prices erode is not merely a matter of technical knowledge, but one of pure behavioral resilience. This resilience is not built in a single day. An investor who learns to remain loyal to their strategy during small fluctuations can also remain calm during major crises. Habits function here as psychological armor. The foundation of financial motivation lies in channeling your energy only toward what you can control. Interest rates, central bank decisions, or global shocks are storms outside of you. But how you set your sails, your savings rate, your investment consistency, and your mental development is entirely within your control. This shift in focus transforms you from being a victim of the market into the architect of your own financial destiny. Because wealth building depends far more on internal consistency than on external luck. Markets may be prisoners of chaos and volatility in the short term, yet when filtered through time, the return of disciplined behavior turns into a mathematical inevitability. Chaos is temporary. A statistically positive trend is the immutable reward of patience. Disciplined financial habits are the most effective way to reprogram the brain. Every consistent behavior strengthens synaptic connections, turning discipline into a character trait. Over time, you no longer need to struggle to save. Your mind begins to execute the process automatically, like a built-in survival algorithm. Likewise, unplanned spending becomes permanent when repeated. That is why the initial phase is critical. Small but regular steps strengthen the financial muscle. Just like physical training, financial discipline requires practice. The quality of the information you are exposed to defines the boundaries of your financial horizon. Following chaotic news flows traps the investor in a shallow short-term perspective, whereas high-quality information lays the foundation for a long-term vision. Fundamental analysis, macro perspective, and the study of historical data provide a more balanced framework. The information stream you feed yourself determines the quality of your decisions. In the professional world, we call this information hygiene. Filtering out noise and focusing on data is the intellectual dimension of discipline. Financial freedom is not an emotional wish or a romantic dream. It is a cold, mathematical equation. The critical gap between your cost of living and your passive income sources defines the true limits of your independence. What changes this equation is not high earnings, but consistent investing. Many people chase a financial miracle or a dramatic leap. Yet real wealth is built through the discipline of monotony. Investing consistently every month may not create emotional excitement, but it is the most effective and unshakable foundation of financial freedom. The desire to feel the pulse of the market and capture the perfect moment is the investor's greatest weakness. This gamble often ends in disappointment. In conclusion, financial discipline is not a goal, but a way of life. Regardless of income level, anyone can apply these principles. One can begin with a small savings rate and gain experience through modest investments. What matters is not perfect timing, but consistent behavior. Wealth building is not a race of speed, but a test of endurance. Those who reach financial peaks are not the ones who sprint fastest from the starting line, but those who regulate their breath and take the most unwavering steps. An investor with average market intelligence but strong discipline will, in the long run, outperform a highly intelligent yet inconsistent investor. Because in finance, sustainability is more valuable than brilliance. Every small yet conscious step taken today becomes the first brick of your future financial self. Remember, wealth begins with a revolution in mindset, takes shape through unshakable habits, and ultimately transforms into a monument within the cold numbers of a balance sheet. The pen that designs this architecture is in your hand alone, and the blueprint is entirely under your control.